Probably weren't expecting to talk about deflation in today's environment when I believe the CPI print yesterday was 7.8 or on Wednesday was Thursday 7.8%. Absolutely incredible. I mean, we're seeing higher inflation we've seen in over 40 years, but I'm still going to talk about deflation because inflation is not a real risk to multifamily. Certainly the macroeconomic, second, third, and fourth order effects could affect the broader economy, which could put us into a recession. And that would affect multifamily, but inflation itself is not a risk to multifamily. But deflation is. And it's not a risk. It's not a clear and present risk at the moment, but it's one of the bigger risks that is out there that is worth mentioning. A lot of this is driven by slowing population growth, an aging population, the technological advancements, which are highly deflationary. We see this growth rate trend over basically to the next, call it 80 years or so. And we're really seeing, a slowdown in the growth rate. You can see that projected, again, we're just going to have an older population, a graying population, and that's going to create more dependency. When you're in your older age, you're not spending as much money. The velocity is lower. You're not obviously having kids, buying more stuff. You're retired. And it also, requires more resources to take care of people. So this is a chart that the Census Bureau put out of just dependency, looking at youth dependency, old age dependency, and just total dependency. You can see by about 2030, we're going to be at a dependency level that we haven't seen really since the 1970s. But we're relatively okay for the next 10 years or so. And then that's not in itself a major risk factor, but they're all forces that create a slower growth economy. And wrapping into kind of a deflationary environment and population growth, one of the biggest risk factors, this could have been a risk factor all in itself, is really lack of immigration to the United States. As you can see, most of this population growth is supported by net immigration to the United States. If we do not have continued immigration to the United States, we will have a declining population here before we know it. And so these projections, in 2020, the majority of the natural increases are from people born here in the United States. In 2030, that switches. That's not the case. It's all of a sudden a 1 to 1.1 ratio of natural increases compared to net international migration. By 2040, it's going to be completely offset at 0.6 natural increases and 1.1 for net international migration. So if we don't allow people to keep coming to this country, in a safe way, we are going to see a declining population and a slower growth economy. So what can we do? We can force appreciation again. So if we have slow rates of growth, slow rent growth, we can always force appreciation through our value-add business plans to create the right type of housing unit for that environment. We're also looking for growth markets. We don't want to be in those markets that are not growing or really stagnant. May also mean not being in some markets that maybe have volatility exposure based on immigration, because we don't know what immigration policy is going to be. But also markets that are low supply, low construction supply. That way, there's that less risk of building up, seeing population decline, and just having too many housing units.